Let me talk about what I'm going to tell you. A long-short fund is basically a fund which is trying to capture the volatility in the market. Shankar talked about volatility, he's not here right now, but that's what we are expecting also. And by the way, the fund that I'm talking about is our offshore fund, which we've been around for the last 19 and a half years, from July of 2005. The markets from that period onwards till Jan end are up 13 times. That fund is up 25 times. So despite being a long short fund with a beta of 0.52 and a net exposure of 63% has given you that kind of phenomenal returns. Why? Because of volatility. All we're trying to do out here is have a low beta when the markets are on the way down and a high beta when the markets are rising. It's very easy to do that in a long short fund. Very difficult to do that in a long only fund. Because the only thing you can do in a long only fund is sell equity, have a cash which is zero beta. But what we do out here is we short. We short single stock futures which are naked. We don't own those stocks. We're shorting which we don't own. That's why they call naked shorts. When you do that, you add negative beta to your portfolio and drastically reduce the beta of your portfolio. So let me start off with a question actually. Sorry. If you knew that the markets are going to go up 200%, or rather 100%, sorry, in 2 months, would you go with a long only, which is 100% exposed to the market, or with a long short, which is 60% net exposed to the market? Let me give you a hint. I'm here to sell you a long short. Well, the answer is not that. The answer is actually, it depends on the volatility. Here's the thing. Suppose the market went up 900% in the first month. Your $100 became 1,000. But the next month, the market corrected 800%, 80%, and your $100,000 became 200. You saw the whole journey, 100 becoming 1,000 to 200, money doubled, but you saw the whole journey. What's going to happen in a long short with 60 net? When the first month, when the market was up 900%, I'll be up only 60% of 900%. So I'll be up only 540%. My NAV is 640. You'll be cursing me that month that I didn't give you the kind of return that the market saw and stuff like that. But the next month, you'll be touching my feet. Because when the market corrected 80%, I didn't go down 80. I went down just 60% of 80%. So I went down 48%, and as a result, my NAV was 333 rupees. 133 more than the long only guys, right? Magic. But that's not magic. That's how it works. That's how volatility works. Now let me show you how volatile India is. Okay? So we've been around in the market for the last 234 months. From July of 2005 till Jan of 25. These are monthly data. So what we did during this time was we taken the S&P 500. This is the return of S&P 500, right? So what we did was we took the monthly returns of S&P 500, put the positive months in one bucket, multiplied them together. Took the negative months, put them in another bucket and multiplied them together, right? And ultimately multiplied the two buckets together and came down to the same return. By the way, that's how a series return is calculated. The sequence doesn't matter as long as you multiply the whole series, right? So you're with me. So I'm not doing any jugglery of data out here. This is actual data that we're talking about. US was up 59 positive months. US was up 15,000% in the 159 positive months. They had 75 negative ones where they lost 95.4% of the returns they made in the positive months, and as a result, they were left with 615%, right? That's how it was. Now let's see the volatility in India. The black line that you see, that's India on the same scale as the US. Look at the volatility. We had lesser positive months, 143 positive months. We were up 68,000%. 68,000 as compared to US 15,000. We lost in the negative months, which are obviously higher than the US, 91 negative months. We lost 98% of the returns that we made in the positive runs. As a result, you were left with 1.9%, and this is the final return that you're seeing, 1,200%. Right? Yeah? Now, if I was to just simplify it, if I said that in the positive months, the market went up some 70,000%. And in the negative months, you lost 98%, you were left with a residual 2%. 2% of 70,000 is 1400%. That was the return of the market. I am a long short guy. I run with a 63% net portfolio. So suppose I just make 1 extra percent for you. In the downside, instead of falling 98%, I fall only 97%. My return becomes 3% of 70,000, which is 2100%. Now, can you imagine the problem the long only guy is going to have? He will have to make an additional 35,000% on the long only months, on the positive months. His return has to be 1,05,000% just to meet my 1% conservation on the downside. 1,05,000 into 2% is 2,100, right? So that's what it is. This is the whole story of a long short fund. Try and conserve on the downside. You won't capture the whole of the upside or either, right? But even if you capture the part of the upside, you already won the game by conserving on the downside. Now this is about theory, right? Let me show you practically what happened. Sorry. So that was, by the way, I haven't skipped the slide. The same slide which I just explained to you. So let's talk about practical here. This is our fund returns. I told you that the market gave a positive return of 68,000%. By the way, what I've done is I've broken up into 2 time periods. The one which is 2008 December and before, and then Jan and beyond, Jan 09 and beyond, right? What I'm trying to show you is that across time periods, the theory works. It's not that it can only work in a bearish market or in a bullish market. The whole idea is the market has to be volatile. Even if it's a flatline market, it has to be volatile for this theory to work. That's why when someone asks me that, what do you think, when should one be investing in a long short? Is it in a bull market or a bear market? I say it's a portfolio for all markets. You know that the markets are going to be volatile, so you better be invested in this. So here's the sum total of what we did in the last 235 months that we've been around, right? The market in the positive months, this is all from July of 2005 to Jan of 25. The market in the positive months gave a return of 68,000%, right? You with me? Yeah. This is the one. I don't know whether you can see the pointer, but this is the return. Our return was a pathetic 14,000% in the positive months. That's because we swing from 0 net to 19 net, right? That's what we swing around with, and it has to be very actively managed. But in the negative months, when the market lost 98%, we lost only 84%. Our return, 2,200% as compared to market of 1,200%. That's what I said. The market gave a 13x return, we gave you a 23x return. This is the beauty of a long short. Conserve on the downside, right? The whole thing is that you cannot short based on technicals. Shankar said, fire the analysts and hire technical guys. I don't think so. Shorting has to be done on fundamental basis because you need an anchor to hang on to your shorts. You just can't have a trend line telling you whether the market is going down or up. You need to understand, or the stock is going up or down, right? You need to have some fundamental anchor to hang on to your shorts. And that's how we go about doing this also. By the way, this is without 2008. Again, we've done phenomenally better than the market. This is the market return. This is our return. This is if we didn't have a 2008 in our life as such, yeah? So this is how we went about identifying the shorts. By the way, this is the last 20 years history of NSE 500 broken up on a yearly basis. Sorry, someone's taking photographs, so I'm moving out of the thing. So this is the last 20 years history of NSE 500 broken down yearly. What we did was we took each and every stock of NSE 500 and ranked them according to the returns every year. Please look at the sum line total which is out here, the cumulative return. The cumulative return of NSE 500 in the last 20 years has been 1,500%. 220 stocks on an average, which is 44% of the participants of NSE 500 have beaten the NSE 500, right? 44% of the stocks, right? Please look at the 150th best return, 20,000%. This is the 150th best stock. 30th percentile of the index is giving you a return which is almost 14 times or 13 times that of the index. Look at the 200 best name, the 40th percentile, 2,900%, almost double that of the index. So what we're trying to show you here is a lot of stocks do well. So don't feel FOMO if you lose out one stock. There'll be 20 others which you can play with, right? Okay, I still haven't understood this. Okay, yeah. So this is the problem area. These are the bottom 200 stocks. This is what you need to avoid to make yourself a success, to beat the index. Now look at the return of 300 best name, minus 17% as compared to the index return of 1500%. Purely by avoiding these bottom 200 names, your returns would have been far greater than the index. Why I'm showing you this is because our philosophy is based on this. Our philosophy is called, and by the way, we derived it from this. We took these underperformers and we said, what is bad with these guys? Why bad? Because there's a definition for bad. There's no definition of good, right? If I ask you how you define a good person, you'll say a person who does not commit sin. Sin is bad. A person who does not steal, steal is bad. So the whole point is the absence of bad is considered good. It's very easy to identify bad from good because you know what bad is, right? So that is the whole philosophy out here. So we took these bad stocks, the stocks which are underperforming, and said, what's wrong with these guys? Why are they bad? And we came up with these 8 factors. These are our factors of rejection. We reject stocks on bad factors. We do not select stocks on good factors because we know there's nothing good. When you keep rejecting on these factors, by the way, what we did realize was that even one single factor was enough for that stock to underperform consistently. Till that factor was met, the stock kept underperforming. So now here's what we did. We only had to now put in such an order that you know, order of importance obviously, that when you reject on one factor, you don't have to trace them against the rest. So that's it. When you reject on the second, you don't have to trace them against the rest 6. That's what we did. And these were the 8 factors that we came up with. And as we keep rejecting, they become our short candidates. When you reject a stock, it's our short candidate because we know why we rejected that stock. I know that I rejected it because the management was bad, right? Till the management turns good, probably it will be a structural short in my portfolio. Or I rejected it because the valuations were high. By the way, the first 6 factors are fairly long-term in nature. The first 3 deal with the industry and the next 3 deal with the group in some way or the other, right? So when you reject on these 6 factors, they are my structural shorts. When we started off in 2005, we put in NSE 500 through this selection process. At the end of the 6th factor, we were left with some 200 odd stocks, 199, 195, I don't know the exact number, but that was how much we were left with. The last 2 factors, which are short to medium term in nature, are very important because they provide that freshness to my portfolio. They keep refurbishing my portfolio on a regular basis. One of them is called medium-term triggers, which could be M&A activity or could be some quarterly numbers or could be some corporate announcements and stuff like that. And the last one is valuations. Can you imagine I told my analyst not to look at valuations till the time he clears the first 7 factors? Because I don't want him getting confused. One day he'll come to me and say, look, the stock is cheap, but the management is bad. My answer to that is the stock is cheap because the management is bad. So avoid looking at valuations, just go there and do it. So that's what I was trying to tell you, that the pool that is at the bottom of this is my investable pool. Again, I don't know whether that's good because there's no definition of good. You have only definition of bad. So these are all not bad stocks. But the ones which I've rejected out here become my short candidates. The first 6 factors, structural. The next 2, opportunistic, right? And how that works is, I don't have much time, but let me just tell you, give you an example. Asian Paints, right? In 2005, made it right down to the bottom of this pool, investable. 2019, when the world was blowing up, in the sense, Yes Bank happened, then Dewan Housing happened, ILFS happened. Everybody wanted to run for safety. Asian Paints hit a P of 70 for an earnings growth of 20%. Didn't satisfy our valuation parameters, so went behind the 8th factor. Then came 2022 end. Grasim announced their entry into paints, but with a capacity which was equal to 40% of India's existing paint capacity. Sincere player, very serious player. We went to Asian Paints. Their answer was that, look, we're going to protect our market share at the cost of our margins. Negative triggers, moves out here, right? You saw what Asian Paint did from 22 onwards. Hasn't gone anywhere as such, right? But we didn't short in 19. We waited for a trigger. The trigger wasn't Grasim. The trigger was the war between Russia and Ukraine. Crude prices shot up. They passed on some amount of crude inflation, but later the volumes came down for Asian Paints, and that's when we shorted. That stock is short in our portfolio from that day onwards. It's been 3 years and the stock is short, right? Why? Because the triggers haven't played out. The triggers started playing out from September of 24 onwards when they declared their results. Top line up, bottom line negative. Then came December, top line negative, bottom line more negative, right? That is what the triggers are. So you got to play it out. We'll wait for a couple of more quarters before we look at that. Even on the long side, we try to be a bit smart on the portfolio. I said by the way, today that now the universe that we have in the final list is around 135 odd stocks as such, and very refreshed from the 95 that I had in 2005. Probably another 30 are repeating out here. Otherwise, the rest all has got refreshed as such. So here's what we do. We try to break up the portfolio into two parts: the low beta and the high beta. Depending on our view of the market, when the markets are looking bullish, this portion becomes a bigger weight. And when they're bearish, this portion becomes a bigger weight. So in short, that's how we manage this. Having said that, am I on the next slide? No, I'm not. I still haven't got the hang of it. Okay. So this is how we do the exposure management. We've been doing that for the last 19.5 years. Someone told me that why don't we give a weight to the heat map as such? My feeling is that it can't be weighted. Things change. Sometimes the macros will be more important than the fundamentals. Sometimes the fundamentals are more important or the sentiments are more important, right? So we go with a heat map. And that's what the heat map shows us. Whatever that does, we follow that to the T. This is how the heat map works for us. If all 4 factors are green, we'll be closer to 80. If all 4 factors are 2 or 3 are green and 1 is, okay, you got the picture, right? So I won't even repeat that. That's how it is. So basically, depending on the heat map, we change the exposure in the market. So that's how it is. Any given point of time in the year, I mean, you've seen the returns of the Nifty, right? Minus 27%, you still have sectors which are green. Plus 31%, you still have sectors which are negative, right? So you still get enough ideas for doing longs and shorts as long as you keep following your anchor for your shorting as such, right? So that's what I'm trying to portray out here. Sorry. Now that's the proof of the pudding, right? That's what I want to say for the last. Please look at the capture. These are the good times that we had. I'm trying to show you that we can even capture when the markets are rallying. You can capture the bulk of the market. The negative period, the market went down 20%. We were down only 4%, right? But in the positive period, immediately after that, that is 15%, we were up 32. It doesn't happen all the time. Most of this, sometimes we are lucky also. But anyway, again, market down 18, we were up 16, not down 16. Market up 13 on the capture. We were up 26. Look at this. These are the captures that I'm trying to show you. So that's what I've said, that all you need to do is manage the beta of the portfolio, and that's how you work. And this is our lifetime story. Positive alpha of 3.27 or whatever, 3.2%, 3.5%. This is annualized alpha for the last 19.5 years, despite the market being up 13 times. That's the return that we're talking about. And any time period, we beat in the market. Any time period. 3 years, 5 years, 10 years, 15 years since inception. Right? I'll stop here. I still have 1 minute. I'm being very lenient. So I'll stop here. Oh, by the way, this is how we do the long and short part of the portfolio. This is basically the longs that are there and the shorts within the same sector. By the way, we never short the same stock. There's no hedging. As I said, it's pure shorting, naked shorts. So whole idea of managing the exposure, by the way, you'll also be surprised how we manage the portfolio. So when the markets are negative, normally people assume that the exposure to the market should go down. In our case, the exposure to the market goes up because at any given point in time, we're 100% long, and then the short works. So when I'm negative, my exposure, suppose I'm running a net book of 70, which is 100 long and 30 short. So my gross exposure is 130 in the market. But when the market is looking dicey, my short book moves up from 30 to say 50. My net goes down to 50. Here my gross exposure has moved up. And when the markets are bullish, my gross exposure compresses because this 50 will then become 10 or 20 or whatever. So my net will be 70, 80 or whatever I'm comfortable with. That's how it works. Thank you all. I'll stop here. I don't have anybody to warn me also. Oh, time is up. Okay, sorry. So thank you, everybody. And I don't think we have time for any Q&A. Otherwise, I would love to answer questions. Love to count the Shankar, especially since he's not around. So